The finance minister's recent budget introduced tax cuts for the middle class while keeping infrastructure spending flat. Now, this move has puzzled many observers. Why would the government prioritize tax relief over an infrastructure push, which has been a core focus in recent years? The answer lies in growing concerns about an economic slowdown. A range of indicators suggest that India's momentum may be waning, from sluggish GDP growth to weakening household consumption. Let's dive deeper into the data and understand what's happening. India's stock market has been on a historic rally for the past 2 years, fueled by optimism about the country's economic growth story. Foreign investors viewed India as a compelling alternative to China, driving record inflows. But the enthusiasm has begun to fade. Foreign investors pulled $11.2 billion from Indian equities in October, marking the largest single month outflow on record. Another $2.5 billion exited in November. These figures highlight the shifting sentiment towards Indian assets. The sell-off is partly due to India's high stock market valuations and the appeal of China's stimulus measures, which have drawn capital back to the Chinese markets. Corporate investments is another weak spot. The share of corporate investment in GDP has declined sharply over the years. From about 25% in 2008, it has now fallen to around 13 to 14% since 2020. Many companies are hesitant to invest in expanding capacity due to weak domestic demand. Moreover, competition from cheap Chinese imports has discouraged local businesses from increasing production. Without a meaningful pickup in investment, job creation will remain sluggish, limiting the economy's ability to sustain higher growth. Capex investments have remained muted as businesses wait for a stronger recovery in consumer demand before committing to expansion plans. Inflation remains another major concern. Headline inflation surged above 6% in October, exceeding the RBI's upper tolerance band. Even after moderating slightly to 5.5% in November, prices remain elevated, particularly in food and beverages, which have seen cumulative inflation of more than 35% since 2020. This persistent inflationary pressure has eroded consumer purchasing power and squeezed household budgets. With real wage growth struggling to keep up, consumers are feeling the pinch, affecting spending behavior and overall demand in the economy. Retail credit, which had been a major driver of consumption, is also under pressure. The RBI has taken steps to rein in unsecured lending, forcing banks to set aside more capital against risky retail loans. This has led to a slowdown in credit expansion, directly impacting consumer spending. Notably, the number of new credit cards issued by Indian banks has declined, indicating a tighter credit environment and reduced consumer appetite for debt. With borrowing costs remaining high, household spending has become more restrained. Household saving rates have also declined significantly since the COVID-19 pandemic. As inflation eats into disposable income and urban wage growth stagnates, many households have been forced to dip into their savings to maintain consumption levels. This trend poses risks to future financial stability as lower savings reduce the ability of families to withstand economic shocks and limit long-term wealth accumulation and creation. Another key indicator of the slowdown is weakening urban demand for consumer goods. FMCG sales growth slowed to just 2.8% in the September quarter, down sharply from 11% in the same period last year. While rural consumption is holding up better, urban demand has weakened significantly. High inflation and stagnant incomes have made consumers more cautious in their spending patterns, impacting retail sales and discretionary purchases. The slowdown in core sectors such as construction and manufacturing further underscores the weakening economy. Manufacturing, which is central to the Make in India push, saw its gross value added or GVA growth plummet from 14.3% in the same quarter last year to just 2.15%. The construction sector, another major driver of economic activity, also slowed down. Both sectors are highly sensitive to investment sentiment, and the lack of fresh capital expenditure has translated into sluggish growth. Looking ahead, many economists expect monetary policy to ease as a new RBI governor takes charge. Additionally, government spending is likely to increase after elections. However, the broader economic slowdown is expected to persist for at least another 6 months. The question for investors is, how should they position their portfolios in this environment? One strategy is to hold assets that provide stability in uncertain times. Gold and the US dollar are classic safe haven assets that tend to perform very well when economic risks rise. With the Indian rupee facing depreciation, USD denominated investments could offer protection against currency weakness. Another area of opportunity is attractively priced banks. While the credit card crackdown has hurt lending in the short term, well-capitalized banks with strong balance sheets could emerge stronger as conditions stabilize. These institutions are likely to benefit from a rebound in credit demand once policy loosens post-election. Finally, consumer companies with strong pricing power remain a compelling bet. In an environment of persistent inflation and weak real wage growth, companies can pass on higher costs without losing customers. Those companies will fare better than those facing margin compression. Firms with dominant market positions and strong brands should be able to navigate this challenging landscape more effectively. India's long-term economic story remains promising, but the current slowdown is a reality that investors must navigate carefully. A measured approach, focusing on resilience, quality, and inflation-protected assets will be key to weathering the months ahead. Let me know if your thoughts in the comments, and are you adjusting your investment strategy? Subscribe for more updates on India's economy and markets. Thank you.